Hello and welcome to another enlightening episode. But before we delve into the world of leverage and margin trading, remember that this content is not financial advice. Always do your own research. Now, what exactly are we talking about when we mention leverage and margin trading? Think of it as a tool that traders use to amplify their trading power. It's a way of maximizing potential profits by using borrowed funds. This concept is widely applied in both stock and cryptocurrency markets. The importance of leverage and margin trading cannot be overstated. It can be a game changer, opening up opportunities for traders that would otherwise be out of reach. Today, we're going to explore and compare how these mechanisms work in both the stock and cryptocurrency markets. What are the similarities and differences? How can they impact your trading strategy? Join us as we delve into the intricacies of these two markets. Now let's take a closer look at leverage trading in the stock market. In the world of stock trading, leverage is essentially a loan provided by the broker to the investor. This allows the investor to buy more shares than they could afford with their own capital. Think of it as a tool that amplifies your purchasing power. For instance, with a 2-to-1 leverage, a $50 investment can effectively buy $100 worth of stocks. This can be quite appealing for investors who are confident in their predictions and are seeking greater returns. With leverage, the potential profits can be significantly higher. If the stock's price rises, the investor gets to keep the profits from the entire amount of the purchase, not just the amount they initially invested. So, if you were to invest $100 with a 2-to-1 leverage and the stock price increases by 20%, you'd gain $40 instead of just $20. However, it's important to remember that leverage is a double-edged sword. Just as it can amplify your gains, it can also amplify your losses. If the stock's price falls, the investor is still responsible for returning the borrowed money. So, in the same example, if the stock price drops by 20%, you'd lose $40 instead of just $20. This can lead to significant losses, potentially even more than the initial amount invested. Moreover, the broker charges interest on the borrowed money, and this cost must be considered when calculating potential gains. It's also crucial to remember that leverage increases market exposure, meaning that changes in the market can have a larger impact on your investment. To use leverage successfully, it's necessary to have a solid understanding of the market and a well-thought-out investment strategy. It's not a tool for the faint-hearted or those without a risk management plan. And that's a basic overview of leverage trading in the stock market, but how does it compare to cryptocurrencies? Now we shift our focus to the world of cryptocurrencies. Just as in traditional stock markets, leverage trading is a common practice in cryptocurrency markets. However, there are some unique characteristics that set it apart. In a nutshell, leverage trading in cryptocurrency allows traders to borrow funds to increase their trading position. This means you're not just trading with your own capital, but also with borrowed money, amplifying both your potential profits and potential losses. One of the key benefits of leverage trading in cryptocurrencies is the high volatility. Cryptocurrencies are known for their dramatic price swings, which can lead to potentially large profits. With leverage, these profits can be significantly magnified. For instance, if you leverage a trade at 10-to-1 and the price of the cryptocurrency increases by 5%, your profit would be 50%, 10 times the initial gain. But as with all things, there's a flip side. The same high volatility that can lead to large profits can also lead to large losses. If the price of the cryptocurrency decreases, your losses are magnified in the same way as your profits. And because you're trading with borrowed money, you may end up owing more than you initially invested. This risk is further amplified by the fact that cryptocurrency markets operate 24 hours a day, 7 days a week, meaning prices can change dramatically while you sleep. Furthermore, the lack of regulation and relative newness of the cryptocurrency market can also add to the risk. Unlike traditional stock markets, which have established regulatory bodies and a long history of operation, the cryptocurrency market is still in its early stages. This can lead to unpredictable market behavior and increased risk. So, while leverage trading in the cryptocurrency market can be a powerful tool for experienced traders, it's not without its risks. As with any form of trading, it's crucial to understand these risks and to only trade with money you can afford to lose. So that's a quick dive into leverage trading in the cryptocurrency market, but what about margin trading? Let's now turn our attention to margin trading in the stock market. Margin trading is a fascinating facet of the financial world. It's like a double-edged sword, offering both heightened returns and amplified risks. It's a practice where investors borrow money to buy more shares than they could with just their own cash. Imagine being at an auction where you've set your eyes on a priceless artifact, but the funds in your pocket are not sufficient. That's when a generous friend steps in, offering to lend you the extra cash. Margin trading works in a similar way. The stockbroker is your generous friend, lending you the extra funds to buy more shares than your initial investment can afford. This borrowed money expands your buying power, allowing you to own more shares of a company. Say for instance you have $1,000, and you're keen on buying shares of a company trading at $10 each. With your own money, you'd be able to buy 100 shares. But with margin trading, you could borrow another $1,000 from your broker, doubling your buying power and enabling you to buy 200 shares instead. The allure of margin trading lies in its potential for greater returns. If the stock price rises, you'll reap profits from a larger number of shares. But remember, the sword cuts both ways. If the stock price falls, you're looking at losses from those extra shares. Plus, you still need to repay the borrowed money to your broker, often with interest. So, while margin trading can be a powerful tool for investors, it's not without its risks. It's crucial to have a robust risk management strategy in place and to stay informed about market trends. And remember, you're using borrowed money, so the stakes are higher. That's a snapshot of margin trading in stocks, but how does the cryptocurrency market fare in comparison? Finally, let's examine margin trading in the cryptocurrency market. This exciting and sometimes turbulent world of digital currencies offers its own unique opportunities and challenges when it comes to margin trading. Just like in traditional markets, margin trading in the cryptocurrency realm involves borrowing funds to increase potential returns. However, there are some key differences. For instance, the volatility of cryptocurrencies can lead to larger gains, but also more significant losses. It's a double-edged sword that traders need to handle with care. To engage in margin trading with cryptocurrencies, traders open a margin account with a cryptocurrency exchange. With this account, they can borrow funds to buy more cryptocurrency than they could with their own capital alone. This borrowed money comes with interest, which the trader must pay back, along with the borrowed principal, regardless of whether the trade is successful or not. Now let's talk about the benefits. The most obvious one is the potential for increased profits. With more capital at their disposal, traders can buy more cryptocurrency, which could lead to larger returns if the price goes up. However, this isn't without its risks. The volatile nature of cryptocurrencies means prices can plummet just as quickly as they rise. If a trade goes south, the trader could end up owing more than they initially invested. This is known as a margin call, and it's a scenario every trader wants to avoid. Furthermore, the interest on the borrowed funds can quickly add up, especially if the trade isn't immediately profitable. This is why it's crucial to have a solid understanding of the market and a well-thought-out trading strategy before diving into margin trading. And that's margin trading in the cryptocurrency world. It's a thrilling ride that offers the potential for high returns, but it's not without its risks. As always, it's essential to do your own research and be aware of the potential pitfalls. With careful planning and a keen eye on the market, margin trading can be a powerful tool in a trader's arsenal. Let's summarize what we've learned. As we wrap up, let's revisit the key points we've discussed today. We've delved into the fascinating realms of leverage and margin trading, both in the world of stocks and the ever-evolving sphere of cryptocurrencies. In stocks, leverage trading allows you to bolster your buying power, while margin trading lets you borrow money to invest. These strategies, while potentially lucrative, carry inherent risks that every investor should consider. In the cryptocurrency market, the principles of leverage and margin trading are similar, but the volatility of the market adds an extra layer of risk and reward. Whether you're trading stocks or cryptocurrencies, it's essential to remember that these are not guaranteed money-making strategies, but tools that, if used wisely, can enhance your investment potential. Thanks for watching. We hope this comparison of leverage and margin trading in stocks and cryptocurrencies has been illuminating. Don't forget to like, comment, and subscribe, and hit the bell notification for updates on our next video.